the Federal Reserve just did something in its entire history it has never done before. It opened its emergency dollar window, the one built for American banks, to a foreign government. Japan can now walk up to that window, hand over a stack of U.S. Treasury bonds, and walk out with fresh dollars. No selling, no panic, no crashing the world's most important bond market on the way out. And the U.S. Treasury Secretary didn't just allow it, he said he wants to make it bigger. Now, I've been doing this a long time. I've been through enough cycles to know that when the plumbing of the system changes, that's not a small thing. That's the thing. Most people are watching the headlines. I want you to watch the pipes, because when you change how money moves through the system, you change everything downstream of it. Your savings, your job, your currency, all of it. And I'm going to walk you through exactly what happened, why it happened, and what I'm personally doing about it. Before I get into it, I want to ask you for something. If you're going to sit through the next 20 minutes of this, and I think you should do me a favor and subscribe first. I'm not going to pretend this is nothing. What I'm about to walk you through took me years of sitting in rooms with people who move markets to actually understand. You'd pay a lot of money for this kind of thinking in most places. I'm giving it to you for free. All I ask in return is you stick around for the next one too. So let's start with what actually happened, because most of the coverage of this got the mechanics wrong. And if you don't understand the mechanics, none of the rest of it will make sense to you. There's a facility at the Federal Reserve. Think of it like a pawn shop window, except the customers are entire countries. It's called a repo facility. And what it does is simple. Once you strip away the jargon, a foreign central bank, in this case the Bank of Japan, walks up with a pile of U.S. government debt. They hand it over as collateral. The Fed hands back dollars. A day or two later, or sometimes longer, they reverse the trade. Japan gets its bonds back. The Fed gets its dollars back, plus a small fee. Nobody sold anything. Nobody moved the market. That's the whole trick. Now, here's why that matters. And this is the part people skip past too fast. Japan has been spending enormous amounts of money defending its currency. The yen has been getting hammered, and to defend it, Japan has had to raise cash. And the way they raised cash historically was by selling U.S. Treasury bonds, because Japan happens to be the largest foreign holder of U.S. government debt on the planet. But when you sell that much debt into the market at once, you push interest rates up. And rising rates on a $40 trillion pile of debt is not a footnote. That's a real cost, and it compounds. So the old way of doing things, selling the bonds, defending the currency, was quietly becoming a threat to the very market it was supposed to protect. What the Fed just did was hand Japan a different tool. Instead of selling, you pledge, you borrow against the asset. Instead of liquidating it, same result for Japan. They get their dollars, but a completely different effect on the market, because there's no forced selling, putting pressure on rates. And here's the detail almost nobody talked about. This facility was built back during the pandemic in 2020 as something temporary, something for emergencies. Then in 2021, quietly, it was made permanent. The cap on how much a single foreign bank could borrow was set around $60 billion. And now, right now, the U.S. wants to raise that limit specifically for Japan, and probably for others down the line. That's not a small technical adjustment. That's a decision to permanently widen the pipe. I want you to sit with that for a second, because when institutions build permanent infrastructure quietly during a crisis and then expand it once the crisis has passed, that tells you they expect to need it again. You don't build a bigger pipe unless you're planning for more water. Now, to understand why Japan needed this in the first place, you have to understand the trade that's been unwinding underneath everyone's feet for the last few years. For a long time, Japan kept its interest rates near zero while the rest of the world raised rates aggressively to fight inflation. That gap created what's called a carry trade. Investors borrow cheaply in yen, convert it to dollars, and go buy higher yielding assets somewhere else. It's an old trade. It's a simple trade, and it works beautifully right up until the moment it doesn't. When Japan finally started raising its own rates, that gap started closing and the trade started unwinding fast. I watched an event just recently where something like $1 trillion in that carry trade got unwound in about 40 minutes. 40 minutes. That's not a market correcting itself calmly. That's a market having a heart attack. And when a heart attack like that happens, someone has to step in immediately, or the damage spreads to places that had nothing to do with the original trade. That's the backdrop this facility got built against. It isn't some abstract plumbing exercise. It's a direct response to watching $1 trillion evaporate in less time than it takes to eat lunch. Now let me back up, because I think the mechanics only make sense once you understand the machine underneath them. And this is where my whole way of thinking about markets comes from. I don't look at any single event in isolation. I look at the pattern behind it, because the pattern is usually a repeat of something that's happened many times before, just with different characters. For 50 years, the global financial system has run on one simple assumption. When a country needs dollars, it sells U.S. debt to get them. That selling pushes rates up. It's uncomfortable sometimes. It's outright painful. And every so often, it turns into a genuine crisis. I've watched this exact pattern play out over and over across my career. In 2008, the world ran out of dollars, and the Fed had to open swap lines to central banks around the world to keep the system from seizing up entirely. In 2020, when the pandemic hit, the same thing happened again. Dollar funding froze, and the Fed had to step in fast. In March of 2023, when Credit Suisse was collapsing, 5 central banks, the Fed, the Bank of Canada, the Bank of England, the Bank of Japan, and the European Central Bank, put out a joint statement about coordinating dollar liquidity. It sounded boring on paper. It was anything but. That same weekend, Credit Suisse was forced into a shotgun marriage with UBS, and billions of dollars moves to keep the whole thing from cascading. I want to go back further than most people bother to go, because I think it actually matters here. Back in 1944, the world got together and agreed the dollar would be the anchor of the entire global system, backed by gold, with every other currency pegged to it. That was the deal. It held for about 25 years, and then in 1971, the math simply stopped working. There was more money and debt in the world than there was gold to back it, and rather than the country in charge actually paying down what it owed, the gold peg got dropped entirely overnight. The dollar became what's called a fiat currency, backed by nothing but trust in the country issuing it, I bring this up because that was the last time the world went through a true monetary reset, a genuine change in the rules of the system, rather than just a bad year in the stock market. Everyone who lived through 971 without understanding what was happening got hurt by it in ways that took years to become obvious. The people who understood the mechanics early positioned for it and did fine. I don't think we're anywhere near a change of that scale today. I want to be honest about that. But the instinct behind both events is exactly the same. When the existing system can't handle the amount of debt sitting on top of it without breaking, you don't shrink the debt. You change the system underneath it instead. That is, as close as I can put it, the single most reliable pattern in the entire history of money. So here's the pattern I want you to actually take away from this, because it's the one thing worth remembering long after you forget the details of this specific facility. When something starts to crack in the global financial system, and it always eventually does, the Fed opens the dollar, taps, that's it. That's the whole playbook, repeated with slightly different tools each time. Swap lines in 2008, swap lines again in 2020, coordinated liquidity in 2023, and now in 2026, a widened repo facility for Japan. So different tools, same instinct, same underlying truth. When the Fed starts pumping dollars to a foreign government on an emergency footing, something underneath the surface is under real stress, and they are trying to keep it from spreading before you even hear about it on the news. Now, why do I call this a reset? And I don't use that word casually, because I think words like that get thrown around far too loosely in this business to grab attention, usually by people trying to sell you something right after they say it. Here's my actual reasoning. For decades, the system ran on selling debt to get dollars, and that selling was the release valve. Painful as it was, what just got built is an entirely different release valve, one where countries can access dollars without ever touching the sell button. And when you change the release valve on a system that big, you change the incentives for everyone connected to it. Think about who benefits here. The Fed takes essentially zero risk. They're holding the safest collateral on earth and charging a fee for the privilege. Japan avoids a bond market fire sale. The U.S. bond market avoids a rate spike. It didn't need. On paper, it looks like everybody wins. But nothing in this business is ever a win for everybody. And that's a principle I've learned the hard way more than once. The people who lose here are the ones betting on the old chaos, the traders positioned against the yen, the ones who make their money off exactly the kind of disorder this facility is designed to prevent. Their playbook just got quietly rewritten underneath them, and most of them don't know it yet. That, to me, is what a real reset looks like. Not a headline, a structural change in who the winners and losers are, hidden inside something that sounds boring enough that almost nobody reads past the first paragraph. So what does this actually mean for you going forward? Because I don't believe in explaining a mechanism without telling you what to do with the understanding of it. Here's the plain truth, as I see it, and I've had to relearn this lesson myself more than once, sometimes expensively. Every time a central bank builds a new pipe to pump more dollars into the system, whether that's swap lines, quantitative easing, or a bigger repo facility, the long-run effect is the same. There are more dollars chasing the same amount of stuff, That doesn't make the underlying businesses or assets worth more. It just means the currency measuring them is worth a little less than it was before. Cash starts to look safe on the surface and behaves like a melting ice cube underneath it. You don't feel it happening day to day. You feel it years later when you look back and realize your purchasing power quietly slipped away while you were doing absolutely nothing wrong, just sitting there holding on to what felt safe. I've made real money in this business, and I've also made some of my worst mistakes betting against exactly this kind of dollar expansion, thinking a crisis meant the system would tighten instead of loosen. It almost never does. Almost every time when the machine cracks, the response is to print more, lend more, and expand the plumbing further, not to shrink it. That's not a political opinion. It's just what the historical record shows, going back further than most people bother to check. A country facing a mountain of debt has essentially three choices. It can pay it down through actual growth, which is slow and rare and genuinely hard to pull off. It can default outright, which almost never happens to a country that controls its own currency, because why would you default when you can print instead? Or it can quietly inflate the debt away over time, which is by far the most common path history actually takes, precisely because it's the least painful one in the moment and the most painful one many years later, spread out so thin that almost nobody notices until it's already happened to them. I'll tell you about a mistake I made early on because I think it's more useful than any of my wins. Years ago, I was convinced the debt crisis was going to force real austerity, actual belt tightening at the government level. And I positioned for it like it was a certainty. I was so sure of my own reasoning that I ignored the one thing that mattered more than my reasoning, which is what the people who actually control the printing press have shown you they're willing to do over and over every single time they've been cornered. I lost real money on that mistake, and it taught me something I've never forgotten. It doesn't matter how airtight your logic is, if it contradicts the demonstrated behavior of the people holding the pen. Watch what they do, not what economics textbooks say they should do. The Fed opening this facility to Japan is exactly that kind of tell. It's them showing you in plain sight which direction they'll lean the next time something breaks. Don't argue with them. Just believe it. There's also a shorter cycle sitting inside this longer one, and it's worth understanding because it's the one that actually affects your day-to-day decisions the most. Economies move through short cycles of roughly 5 to 10 years, where credit expands, growth picks up, things feel great, then rates rise to cool it off, and you get a slowdown or a recession. That's the cycle most people are used to living through and reacting to. But underneath that shorter cycle, there's a much longer one, a debt super cycle that plays out over 50 to 75 years. And within that longer cycle, debt just keeps accumulating, recession after recession, expansion after expansion, because each time a smaller crisis hits, the response is another round of stimulus, another new facility, another patch on the pipe, rather than an actual repair. What you're watching right now with Japan and this repo facility is a patch being applied near the very end of one of those long cycles, when the patches have to get more creative because the simple tools have mostly already been used up. So here's what I actually do with that understanding. And I'll give this to you plainly because I think too many people in this business hide behind complexity to sound smarter than they are. I don't sit in cash waiting for clarity because clarity almost never comes before the move. It comes after, when it's already too late to act on it. I spread what I have across things that behave differently from each other. Some real assets, some equities tied to genuine productive value, some exposure outside my own home currency, because I've learned the hard way that betting everything on one outcome, even an outcome you feel very confident about, is how you get wiped out by the one scenario you didn't bother to plan for. I pay far more attention to what the money is actually doing than to what anyone is saying about it, because talk is cheap and flows are not. And I try never to fight the trend the central banks have already shown you again and again, decade after decade, that they are willing to take when they show you their instinct. That's clearly, and this clearly believe them. Let me be a little more specific about what that actually looks like in practice, because I think vague advice is almost worse than no advice at all. When the pipes get widened like this and more dollars get created to keep the system stable, three kinds of things have tended to hold their value across history better than cash sitting in a bank account. Hard assets that can't just be printed into existence. Things like gold, which has done this exact job for thousands of years across dozens of different currency systems that all eventually failed in one way or another. Ownership in real, productive businesses, not speculation. Actual ownership of companies that make things people need, regardless of which way the currency moves. Because a share of a good business is a share of real output, not a promise on a piece of paper, and exposure spread across more than one currency and more than one country. Because when you hold everything in a single currency, you're making a much bigger bet than you probably realize. You're betting that one country's central bank will manage its own currency better than everyone else's forever, without exception. I wouldn't take that bet with my own money, and I don't think you should either. None of this is a stock tip, and I'd be doing you a disservice if I dressed it up as one. What I've tried to give you here is a way of thinking, because the specific headline changes every single year, but the underlying machine barely changes at all. Understand the machine, and you stop being surprised by the headlines. You start seeing them coming a little before everyone else does, which is really the entire game. I'll say one more thing before I wrap this up, because I think it's the part people skip past the fastest and regret skipping the most. None of this happens on the timeline your emotions want it to happen on. That's the hardest lesson in this entire business. Harder than any of the mechanics I just walked you through. You can be completely right about the direction of something and still lose money or lose years of patience because you expected the reset to announce itself loudly, and it almost never does. It shows up quietly in a repo facility, limit getting raised, in a joint statement from 5 central banks that reads like it was written to put you to sleep in a permanent program that used to be labeled temporary. The people who do well aren't the ones who react fastest to the loud headline. They're the ones who were already positioned before the headline existed because they understood the machine well enough to see the pattern developing underneath it. That's the whole difference. And it's available to anyone willing to do the unglamorous work of actually understanding how the pipes are laid instead of waiting for someone to tell them the water's already flooding the floor. So here's my challenge to you, and I mean this honestly. Don't take my word for any of this. Go find the actual Bloomberg reporting on this facility yourself. Go read about what happened with the swap lines in 2008 and in 2020 and with Credit Suisse in 2023, and trace the pattern for yourself instead of trusting me or anyone else on the internet to trace it for you. That's genuinely how you build the kind of understanding that doesn't fall apart the first time someone disagrees with you confidently. If this actually helped you see something you hadn't seen before, subscribe, because I'm going to keep pulling these threads as they show up, and there will be more of them. There always are. Leave a comment and tell me what you think is really going on here, because I read every single one, and some of the sharpest thinking I've come across in this business over the years has come from people who were never on any trading floor at all. I'll see you in the next one.